Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 368 on March the 28th, 2025. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on SoundHound AI, AT&T Inc., and the Super Microcomputer Inc., and we discuss three new trades on Iris Energy, Rivian Automotive, and the VanEck Vectors Gold Miners ETF. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on the show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the market's headed back lower on more tariff news this week. The Dow Jones Industrial Average lost 401 points, closing at 41,583 points. The S&P 500 index gave up 86 points, ending the week at 5,580 points. Now it's time for the topic of the week. The topic of the week is greed. The subtitle is recognizing when to be stubborn and when to be flexible. Earlier this week, I was trading a 0 days to expiration, otherwise known as 0 DTE option on NASDAQ futures. The market was lower before the open, and I decided to buy an out-of-the-money put. Much to my expectation, the market fell 60 points on the open. That was great. I made a little bit of money, but I didn't put this trade on for a little money. I felt like this was the trade of the day. So when the market moved against me and my indicator signaled that I should have closed the trade, I decided to ignore them. I was stubborn. Then the market fell some more, and I felt like I was right. When you trade options, you always have to be aware of how much time value you're losing and the effects of fast or slow movements in the market. The market did fall another 50 points, but I didn't make as much money as I had made before. I was losing time value, and the volatility being priced into that option was decreasing because the speed of the price change was slowing down. Then the market moved against me once more, and my indicators once again highlighted that. But I was stubborn. By the time I exited the trade, I had been correct on the market direction, but managed to lose a little bit of money on the option. I walked away blaming my greed. I actually had reached my financial goal for the day in that first move, but I wanted more. Then it became about being right. And being right means making money. Losing money on the option, even though you're right on the market direction, is foolish. Part of the reason I'm sharing this is simply to let those of you know who have done this know that you're not alone. If you've made that exact mistake before, you certainly are not alone. This also is a bit of my own public confession in hopes that I'll do it less often. The better trade for making money and balancing out my greed would have been to close that initial trade when I reached the profit that I hoped for. Next, I would have waited for another opportunity to re-enter the market and make even more money with a closer strike. I could have played that game all day long and made great money and had more fun. Instead, I hunkered down, I folded my arms, and I finished the day grouchy. Don't do this to yourself. If your indicators that have been working for you are telling you to close the trade, use them. Use them for proper entry points and use them for proper exit points. Greed can be a positive or negative thing. It's all about understanding what it does to your own emotions. If it makes you stubborn and inflexible, it's a bad thing. If it makes you take risk that you should not take or can't afford to take, it's a bad thing. If it leads to creativity, flexibility, and confidence, then it's a good thing. In trading, it's important to know the risk involved and to know thyself. You're constantly managing risk and managing emotions. Keep that in mind as you plan your trades this upcoming week. So that's it for the topic of the week. Let's go ahead and get into the review of last week's trades. And as a reminder, I mentioned that the half strikes would be priced as of Monday, and oftentimes you can find better pricing in the markets on that Monday after the market opens. But I want to go ahead and use the trades that were presented on the show. So we'll start off with the covered call. We looked at SoundHound AI, symbol S as in Sierra, O as in Oscar, U as in uniform, N as in November. At the time, the stock was trading for $9.86 per share. I looked at buying that stock and selling the April 10 call at 98 cents, hoping for a return of 11.36% in 4 weeks. Well, shares of SoundHound fell $1.36, ending the week at $8.50 per share. The call option that we sold lost 68 cents, leaving us with a net loss of 68 cents if we were to close that trade out immediately. Now, we are 38 cents below the break-even point and 3 weeks away from expiration. I'm actually leaning towards giving this stock another week. Most of the high volume stocks finish the week lower, and this stock is not out of the price range that it's been in for the last month or so. Now, rolling the strike lower would not yield enough to be super enticing, so I'd rather wait. There are far too many times when a 1 week adjustment led to a losing trade. I should have faith in my original trade. Now, time will tell, and time will provide additional possibilities for adjusting this trade as well. Of course, it's not unheard of for people to make an adjustment by rolling the strike lower and closing this, or deciding to close this trade outright. Risk management is always a very personal decision, so you have to do what makes the most sense to you individually. Just make sure you do the math and understand any ramifications of making an adjustment, closing the trade, or just being patient. All right, next up we have the credit spread on AT&T Inc., symbol T as in Tango. At the time, the stock was trading for $27.03 per share. I looked at selling the April 27-26 put spread at 33 cents. That could give us a maximum possible loss of 67 cents per spread. Now, shares of AT&T grew $1.18, ending the week at $28.21 per share. The out-of-the-money put spread is even more out of the money, and that means that this spread is working out so far. This particular spread lost 16 cents, which means you could actually close the trade right now for a 16-cent profit if you want it. Given that the stock price is still more than $1.50 above the break-even price, no adjustments are needed. So this one worked out nicely. We're just going to leave it alone as well. Finally, there was a debit spread. We looked at Super Microcomputer Inc., symbol S as in Sierra, M as in Mike, C as in Charlie, I as in India. At the time, the stock was trading for $42.15 per share. I looked at buying the April 41-42 call spread for 65 cents. That could give us a maximum gain of 35 cents or a 53.85% return in 4 weeks. Well, shares of SMCI fell $7.89 per share. That's a big drop. The in-the-money call spread that we bought is now far out of the money. This is definitely prime for an adjustment. Now, you could simply close the trade by buying the spread back and lock in a 53-cent loss. I'm not much of a fan of that option, but it would completely close off any additional risk. Now, you can also sell the 41-43 call spread at 24 cents. That would leave you short the 42-43 call spread. Then I would sell a put spread to make an iron condor, maybe the 32-31 put spread at 30 cents. That would mean you've collected 54 cents, so net, you've recovered all but 9 cents of the money that you paid for that original spread. This also leaves you with $1 of exposure on the upside and downside of the stock move. Now, if this stock continued to fall, that risk would become very, very real pretty quickly. You can engineer other trades that will lead to more money on the put or call side of the iron condor. You just have to do the math and be sure to understand the true risk of your actions. That's the name of the game. Understand the risk of your actions, and you always want to be aware of the fact that this stock can continue falling lower, or it could recover $7 in a week. So anytime a stock moves that much, that quickly, just know that it could keep moving, and that might cost you more money if you make the adjustment. So that's it for the trade review of last week's trades. All new trades on today's show will use the April 17th expiration for monthly options in April. So we're going to start off with the cover call. I'm looking at Iris Energy, symbol I as in India, R as in Romeo, E as in Echo, N as in November. The stock ended the week at $6.07 per share. I'm looking at buying that stock and selling the April 6.5 call at 38 cents. That could give us a return of 13.34% in 3 weeks. Now you enter this trade by buying stock for $6.07 and selling the April 6.5 call at 38 cents. This trade makes the most money if stock prices finish above $6.50 per share. The break-even price is $5.69 per share. In real terms, the stock purchase will require $607, and you'll collect $38 for selling the option. Next up, we have a credit spread on Rivian Automotive, symbol R as in Romeo, I as in India, V as in Victor, N as in November. The stock ended the week at $12.41 per share. I'm looking at selling the April 12, 11.5 put spread at 17 cents. That could give us a maximum possible loss of 33 cents per spread. Now you enter this trade by selling the April 12 put at 62 cents and concurrently buying the April 11.5 put for 45 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $12 per share. The break-even price on this trade is $11.83 per share. In real terms, you'll receive $17 per spread that you sell and have $33 at risk. And our final trade on the show today is going to be a debit spread on the VanEck Vectors Gold Miners ETF, symbol G as in Golf, D as in Delta, X as in X-ray. The stock ended the week at $45.58 per share. I'm looking at buying the April 45 half call spread for 31 cents. That could give us a maximum gain of 19 cents, or that's the 61.29% return in 3 weeks. You enter this trade by buying the April 45 call for $1.67 and concurrently selling the April 45 half call at $1.36. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices expire above $45.50 per share. The break-even price on this trade is $45.31 per share. In real terms, you'll pay $31 to enter the spread, and your maximum gain is $19 per spread. So that's it for today's show. First off, I have a thank you. One of my great and faithful listeners emailed me and very graciously pointed out that while I'd been speaking about the SOXS ETF, I have been giving it the wrong name. So the symbol was correct, which is why the pricing was correct, but I kept saying the wrong name, and that's quite embarrassing. It is actually the Direction Daily Semiconductor Bear 3X Shares ETF. So thank you very much. The symbol was right, the pricing was right, but I was calling it the wrong name. I edited that on my end so that won't happen again in the future, but thank you for correcting me and doing it graciously. Sometimes I do bonehead things, and I prove it on air. And I also am happy to be recording the show back in the office. In the month of March, I have recorded the show from Orlando. I have recorded it from Park City, Utah. I have recorded it from Beaver Creek, Colorado. And I have also recorded it from Brenham, Texas, of all places. So thank you guys for traveling around the country with me and ultimately staying with me on this journey. I hope you have a wonderful weekend, and as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.